Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are digesting the progress of reopening the economy. And Phil, it appears that inflation is back, and the details are kind of showing a return toward normal.
Yeah, it was one of the strongest one-month gains that we've seen. And the good news is a lot of people were very fearful that with no demand for products because of all of the quarantining and shutdowning, that we would have deflation, which causes a whole lot of problems for the Fed. If we have deflation, even zero interest rates are positive interest rates when you adjust for inflation. So you sort of raise the prospect that we might have negative interest rates, which causes a whole lot of problems with the bond market. So the fact that inflation is back is probably a good thing for the Fed, as well as for just normal investors that know that we have positive rates of growth for forecasting to a lot of the data. But when you slice the data down, that's where, to your point, it starts to show how the economy is sort of pivoting back closer to normal. Because groceries, which had seen inflation as we all started to shop for our work at home, started to get cheaper instead of being more expensive. Meat came down. But a lot of the old economy products that had got cheaper because no one was buying them have now reversed course and started to get more expensive, like plane tickets, like cars, obviously gasoline that we're all seeing at the pump, but even clothes and large appliances all went up in price. So it's kind of it looks, when you look across the spectrum, like people are getting back to work and people are getting back to doing normal things, and prices are starting to account for that too.
What are you seeing in terms of loan defaults? And also the banks seem to have made provisions. I remember in JP Morgan and Goldman Sachs quarter laying significant amounts of money to the side just to be prepared for this.
Yeah, we talked about it before. I mean, the banks have been making some pretty big provisions considering how strong the stock market is for losses. And even this week, there's a lot of chatter that the loan losses in banks will kind of hold up their profitability, despite the fact that bond trading desks have made record profits because of the Fed's intervention and all of the trading around coronavirus. So we can see in the CMBS market kind of a dispersed range of defaults coming up, where hotels, I mean, it makes sense, hotels have a lot of defaults coming up, but not many of us are probably staying at hotels anywhere near like we used to. At the other side, offices actually aren't defaulting yet, which probably makes sense too, because even though we're working from home, our offices are still collecting revenues from the businesses that we're able to do from home. And in the middle is retail, which probably shows that some shops are open, but the foot traffic's a little lighter than normal. So it really does speak to the different impacts of getting back to work and different rates of getting back to work because of coronavirus too, doesn't it? Where lodging is the most impacted and office is so far the least impacted.
So I want to talk about unemployment. Despite the V-shaped recovery in the stock market, we're seeing economic data slowly improve. There's still tens of millions of people that are unemployed out there. And even if a vaccination does come in Q4, Q1, some of these jobs are not going to come back.
Yeah, I mean, that's true. And that's what the data we're looking at today shows. But also this morning, we had a pretty good employment print. I mean, pretty good, a lot less bad than expected, where we had less than 1 million new applicants for unemployment. So that's the first time it's been under 1 million for weeks. And that's a good sign because people thought it was still going to be above 1 million. So there's more jobs coming back online than we thought. But it's interesting because the data that we're looking at today actually looks at what I thought was interesting, not the dark blue color, which shows the huge spike in people that are on temporary layoff. But what's a little bit more concerning is your point is the light blue color, which shows an increase in the people that think that layoff's not temporary anymore. And so we can start to see there's been some retail companies go broke. There's been some energy sector companies file for bankruptcy as well. There will probably be some job losses that are permanent. And the longer this goes on, the more likely that is to happen. And that's a concern because it means we might end up coming out of this, even with a vaccine, in a more classic recession where demand falls off because people have lost jobs permanently.
Let's wrap up and talk about ETF flows. If you look at different asset classes, the story is different between ETFs and mutual funds.
Yeah, very. And it actually has been for years. It's kind of interesting. If you look at the mutual fund world, and I guess it's a different investor base, there's been sort of a transfer out of mutual funds that invest in US stocks into international stocks and into bond mutual funds as well. So almost like a maturation of the old equity focused mutual funds, the diversification to international. And as people get older with more money, they've been shifting into more and more bond funds. The ETF world is completely different. So what we've actually seen this year is quite a lot of the new money coming into ETFs is going into bonds. A lot of that is still searching for yield. You can see that in the investment grade and high yield space is where a lot of the money has gone. But also we've seen money flowing into US stocks. That's the second most popular category. So you can kind of see the ETF investor is pretty attracted to the US stock market, whereas the mutual fund investor, and it hasn't been for years, but still isn't. So we talked recently about the outflows from equity mutual funds. That's not the case in ETFs. Having said that, year-to-date ETF inflows are only about 250 billion. The mutual fund outflows are closer to 400 billion. So net, investors actually look like they're pulling money out of the whole investment spectrum, which includes bonds.
So before we wrap, I want to ask you about something that has been making the rounds, certainly in the FinTwit universe. In ETFs on the OTC market, DGAZF, the worth of it went from 125 to 25,000. How does that happen?
Yeah, so there's a lot of different factors to account for here. One of the things that's most important is this is very rare. So almost all ETFs track really close to their underlying asset value or their NAV. And that's because of the creation redemption facility that market makers are able to buy the underlying stocks or sell the underlying stocks, do a creation redemption and actually flatten their exposure, which will keep the ETF tracking with the underlying assets almost perfectly, almost all the time. This ETF in particular, it was closed to new creations, and that breaks that effect. It also delisted from public markets and started trading OTC, as you said. So it's a little bit of an unusual case, and it's particularly unusual to see this. Having said that, I think whether you're buying stocks or ETFs, you've got to make sure you understand what is the value of what you're buying. ETFs have a really neat facility. They actually produce a net asset value number. So you can see whether that net asset value is in the ballpark of the price you're paying or not. It's much easier to work out if you're paying too much for an ETF than it is to work out if a stock is rich or cheap. And so I would encourage anybody that's looking at an ETF to consider what the NAV is. And if it's, to your point, thousands of percents rich, it's probably not something you want to participate in.
All right, Phil, appreciate the insight. Thanks so much for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.